Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Jason Cooper, one of our senior portfolio managers. Jason, welcome back to the Market Share. We've seen some changes in the market as we flipped the calendar year into 2025. So let's start with some comments about what we've seen related to Fed rate cuts in 2025.
Yeah, we're getting a lot of information these days. The last couple months we've seen a lot of change with the administration. We've seen a lot of just things coming from them in terms of what's happening there. But I thought, we'd focus a little bit on a couple items that I thought were important right now. One being interest rates, what the expectations are, what they were back in 2024 and what they are in 2025. We just recently had a meeting from the Fed. They've come out and said that they're trying to make sure everything is stable in terms of the numbers they're seeing. But the first chart I thought I would share with everybody is where expectations were and where they are currently with January and into February. And you can see from on the left side, the light blue shaded bars, that represents what expectations were in terms of where the rates might be and where we might potentially see cuts. And then what I've also included is what that looks like in January and into February in terms of what expectations are. And from this, you can see it looks like June might potentially be the next time we see a cut in rates. And if not, then probably somewhere in the latter half of 2025. But definitely the gist of this is just how much those expectations have changed in a very quick way in the last few months.
Yeah. Well, and a couple of reasons are, one, inflation has been a little bit sticky, but two is we continue to have relatively good economic activity, and if you have good economic activity, that tends to delay rate cuts.
Yeah, it feels and seems as though things are going the right direction. Our economy is still very strong. Even globally, our economy is very strong. And I share that in this chart where it shows nominal GDP growth going back to 2010 up until just this past year in 2025. And you can see the averages, and the average they pull out of this chart is approximately 4% is the average when you look at this nominal GDP. And where we are today, or the last instance of this, was 5. So we are still above average, which is good, very good with what we want to do. So what does that mean for earnings going forward and looking back in time with the companies we follow and look at in terms of a nice swath of the market? The next chart does just that, and it shows that different ranges of nominal GDP year over year, and what does that mean for earnings going backwards and forwards. And you can see I've taken this box and put around there to show you this 4 to 5%, which is what I just showed you. And you can see we've had earnings growth of approximately 16, 17%, which is great. But then what we can anticipate is a continuation of earnings. It just might be from other places, but a continuation of earnings growth of 9%. That is significant in that earnings is still part of what breeds this market, what keeps this market going. And that's why I look at the last chart I wanted to share is just the potential of maybe the changing of the guard. We talk a lot, and I know we've talked a lot in these videos about the Magnificent Seven, how much of that represents the market. We know that at some point, and it's been 40% of the market's return is these 7 names. But this last chart shows where earnings were, where income was coming from in a big way with these 7 names, and that's starting to slow down. What's significant is these other 493 names in many sectors, I think we're up to 12 sectors now or industries, is starting to pull more of the weight. And so I think that's great. I think that's constructive from the market. I think we need that, but unfortunately there might be a little bit of pain or volatility in the market as we get away from those 7 and into these 493 names.
So, well, the good things for our clients is we have been underweighted the Mag 7, which really has not helped the last couple years on performance, but we are overweighted the 493 plus. Yes. And so when you look at that kind of chart, that should help a portfolio like how we've designed for our clients.
Absolutely.
So, Jason, obviously appreciate your comments today and joining us as always. If you like today's video, I encourage you to share with your friends, family, or colleagues. If you do not currently receive the market share, you can subscribe using the QR code at the end of the video. And as always, thank you for the opportunity to serve you and your family, and have a great day.